Hello, everybody, and thank you for joining me. My name is Alex Tapia. I'm the president and founder of Aviation Retirement Strategies, coming at you from the Pilot Money Podcast studio here at our ARS national headquarters at the George Bush Intercontinental Airport in Houston, Texas. So today is September 28th. We are nearing the end of the third quarter of 2023, headed into the fourth quarter of the year and the final quarter. And I thought it might be a good idea today to recap what's been going on the entire year, and more importantly, also what's been going on since about July 31st, which is what's the top of the market. And since then, it's slowly been coming down a little bit with a little bit more volatility than we've been used to up until that point. And also from this point forward, what can we expect to see from the markets, and what are we looking at, and how are we going to potentially position the portfolios to adapt for it? Now, if you remember last year, especially towards the end of last year as a whole, it was very difficult to make money because of everything was down, stocks, bonds, and everything was just an ugly time to be in the markets, specifically because the Fed was raising interest rates very aggressively to combat inflation. If you've watched any of my previous videos where I've explained the relationship between bonds and interest rates, they basically have a direct and inverse relationship. And when the Fed starts raising interest rates, the only reason that they do that is because they want to make it harder for companies to borrow and banks to invest, because interest rates are higher and it's a lot more expensive to do so. When you raise interest rates, it creates a drag on the market. At the same time, by raising interest rates, people that are invested in bonds, because interest rates are higher elsewhere that are basically guaranteed without risk, they tend to move the money out of bonds that have some risk associated with them, and then they tend to go to safer investments that basically pay the same thing, which is the reason why bond values goes down when the interest rates rise. Last year, we basically had a perfect storm for all of this, where they're raising interest rates, the stocks are pulling back, and at the same time, the bonds are pulling back. It was very difficult anywhere in the stock market last year to make any money. Well, into 2022, or at the end of 2022, when people were saying we're going to go into this major recession and we better pull out of the market and basically run for the hills, a lot of people unfortunately did. But it turns out that the inflation, or the rate hikes that they did back in 22, actually tamed the market enough where the Fed started saying, hey, maybe we don't need to raise interest rates that much longer. If anything, we may be able to stop them. And once that happens, the market started taking off again. And all those things that were sold off in the last year, they started coming back and then some. Up until July 31st of this year, the market, the S&P 500 alone, grew by almost 20%. Now, since July 31st, we have had some numbers come in that actually indicate that inflation may be coming back once again, at least to some degree, and it has taken the Fed, basically has made them change their mind about what they're going to be doing with interest rates, and they say that they're potentially going to be raising them again. Now, during the last Fed meeting that we had, they basically left the interest rates alone, but they basically hinted that they're going to do it one more time this year. Once again, once you start raising interest rate, it tends to put a lot of pressure in the market. Now, what happened at July 31st, because the market has been so robust for 2023, the market is almost like it was looking for a catalyst in order to start selling off, because you can't just grow and grow forever. At some point, you have to have a pullback. During that Fed meeting that they said they're going to maybe potentially raise interest rates again, that was the catalyst for people to start selling off in the market, and it started going back the other direction. Now, since July 31 and today is September 28th, the S&P 500 is down 6.5% from its total high. So as you've noticed, since that time, obviously the market has not been so robust. It seems like almost every day the market keeps creeping down because everybody's anticipating this rise in interest rates, which they have yet to really announce to what degree it's going to be. That's the reason why the markets have been so volatile. So in terms of what we're doing with our portfolios and your money, and in terms of managing the money that we manage for all of you, there's really no reason to do anything, because the market again was looking for a catalyst to start pulling back, because we have had such a robust year. To date, as of today, I believe the last time I looked, the S&P 500 was still up around 12% for the year. We're still having a good year, and there's really no reason to think that the market's going to be doing anything negative, other than just the basic pullback that's required in order to have a healthy comeback and then start going back towards hitting the highs again for the year. Now, one of the things that is causing a little bit more instability and volatility in the markets than we would like is the potential impending government shutdown. Now, government shutdowns, they do happen at some point. They don't happen very often. In fact, I think I read in the last, since the 1980s, the government has shut down only 18 times, which is a very long time. And I believe, if I'm correct on the dates, that back in 2018, we did have a government shutdown, but it only lasted a few days. But the problem with government shutdowns is, number one, I feel personally that our elected officials are not doing their jobs. They're not really caring enough about the people to actually go in and do the basic things that is required of them. But that's a different story. But at the end of the day, if a government does shut down, it lays off a lot of people, and a lot of people do not get paid because the government doesn't have any funding to be able to pay them, and that results in them not spending money. So economically, it does have a pretty great effect on everything. So that's one of the reasons why you're seeing a lot of volatility. Once that is over, hopefully that we avert a shutdown, and then I think a lot of the volatility is going to be taken away. And plus also the fact that we are entering some impeachment inquiries, and I think they're going to try to impeach President Biden. That causes a lot of volatility as well because there's unknowns out there. But the politics in general, they are right now causing more volatility, instability in the markets than we would really like to see. But those things are temporary. That is not something that we are going to act on from a long-term portfolio standpoint. But we are keeping a close eye on the Fed to see what they're going to be doing. And we're pretty sure that they're going to be raising interest rates one more time this year. I think the market has already priced that in. Again, we have lost since July 31, since the market high, since we've gained 20%, we've given about 6.5% of that back. So right now we're only up about 12% for the year, which is not really a bad year. Now, in the meantime, in terms of our portfolios, we're really not looking to make any major changes. We are certainly not making a fundamental change in our portfolios and our holdings and our allocations, because we do believe that this pullback is temporary and it's a healthy way to get back to hitting the highs for the year and hopefully recover even from the highs of last year, where we began the year, which again was such a dismal year for everyone, which we're still looking to recover from, and everyone really is still. But we're getting closer, and we believe we're going to be closer to it by the end of the year as well. We know that the political environment is only going to be temporary for us. Interest rates, I think that the markets have, for the most part, already priced in another interest rate hike. So we are looking to stay the course with the way we have been. For all of the newer money coming in, we are going to still be fully implementing these portfolios, because as markets are very volatile and volatility goes both ways, we certainly would not want to miss out on a recovery from this latest pullback that we've had since July 31st. In the meantime, if you have any questions about any of this stuff, please feel free to give us a call. We're always ready and willing to talk to you about your specific situation, your specific portfolio, and what the plan is. As each of you has a unique structure here at ARS, and we can't generalize about anything because you have your own unique investment structure. Happy to talk to you about how all of this will affect your specific situation for you and your family. But in the meantime, thank you for listening, and we appreciate your time, and we'll be talking to you soon.